So financial ratios are one of the major tools in the financial analysis part. We already have understood it. So based on the purposes of the financial ratios, purposes means what help they make us, for what purposes. The financial ratios are categorized into different categories, and it is not like that the same category is used everywhere, but you will see the categorization is mostly common, and it is obviously based on the purposes the ratios serve. So some broad categories of financial ratios are, or common categories also, the activity, liquidity, solvency, profitability ratios, valuation ratios. So in terms of the idea that the activity ratios help us that how active or how efficient the firm's management of asset, or how efficiently the firms is managing their asset, that will be learned from the activity ratios. And for the purpose of liquidity, liquidity ratio will help us to know whether the firm is capable to meet up its short-term obligations. And for the solvency part, we look at the long-term capability of meeting up its liabilities. And profitability is a common concern for all of the people, all stakeholders, and people look at the profitability ratios to check that whether firm is doing justice to the investment made to the firm by the investors. Valuation ratios are essential to estimate the stock value, to estimate the fixed income value issued by the companies, and compare it with the market value to make an investment decision or to make a withdrawal decision of investment. So in the profitability category, I see someone has raised hand by this time, 24119. Would you please write your issue in the chat box? 2419. You have raised your hand. Okay. So in profitability ratios, one particular ratio is very much interesting and very much commonly cited. That is the return on equity. So again, the return on equity measures the performance of the firm. I mean the performance in terms of what we have made an investment in a firm. Shareholders made an investment, and based on that investment, how much return has been generated by the management. Okay. Is efficiency ratio a synonym of equity ratio? Yeah, you will see that activity ratios also serve the purpose to know that how efficiently the firm asset is used by the management. Okay. Okay, I was saying the return on equity, and the return on equity measures this purpose, whether the firm or firm's management is doing justice to the investment made by the shareholders, and if they generate a good amount of return on the invested equity, shareholders become happy, otherwise they become unhappy. So it is based on this idea that the amount of return I get from my amount of investment from the shareholders' perspective. And if we convert this in terms of return on equity, we get the return is measured in terms of earnings after tax, or net profit, or net income, whatever it is, and it is divided by the average of beginning and ending shareholders' equity. I mentioned earlier in previous class what is the technical reason and the qualitative reason of taking the average instead of taking either beginning or the ending points shareholder security. And remember those reasons. No one will ask you the formula to calculate the net income, to calculate the return on equity, but you will be asked that why the denomination is this one or why the numerator is this one. What are the argument? Okay. Okay. So one thing I like to re-emphasize, because I didn't put much time in previous class, because the plan is spending more time here, the decomposition of ROE. So it is essential because if you decompose the ROE, you can understand what are the factors which are driving the ROE. And if the ROE changes over time for a particular company, what are the underlying reasons for the changes in ROE over time? And again, if you compare, make a cross-sectional comparison of companies in terms of ROE, you might be interested to get the factor or to get the crucial driver which is causing the changes of ROE among these companies. And if you see there are some areas or some drivers which need to be focused or which need to be taken care by the management, in that case, you can suggest that what are the areas you need to look for improving the ROE. So one very simplest decomposition of ROE is like this, that if we write the ROE in this way, net income divided by average asset, it looks like return on assets, and it looks like leverage. I mentioned in previous class. Now the question, how precise it is in terms of return on assets, this ratio. Question, average asset is contributed by only shareholders or also the creditors? Assets which firm has bought with some money, that money has been provided only by the shareholders or also by the creditors? Write your responses in the chat box very quick so that I can give you the comment. Okay, both, that is good. Good responses are coming, and the answer is both. And you see the net income is attributable to the shareholders' equity or for both? Net income is the return to the shareholders' equity, I mean the equity holders, or also to the creditors? Net income? Yeah, net income is return only to the equity holders, not to the all. Creditors get the interest payment or the financial charges, not the net income portion. And you know that from how we come to the net income by doing some calculation. Okay, you see the numerator is telling something about the shareholders' equity, but denominator is telling something which encompasses both shareholders' equity and the creditors. Are the numerator and the denominator consistent here? If the net income is only for the shareholders' equity, which is numerator, and in the denominator, the asset is contributed by both shareholders' equity and the creditor, does it rightly reflect the return on assets? The answer is no. So which one is more appropriate? EBIT is more appropriate, or you can also write instead of EBIT, which is more precise, that is net income, which is the shareholders' equity portion, plus interest after taxes. Interest after taxes, it is to be given to the creditors and it is to the shareholders. In that case, if you divide this by average assets, it is more consistent. Okay, so these are some technical discussion, but the thing is that we have got the what are the underlying factors behind the return on equity and the return on assets. Okay, now again, another part of the decomposition here is the leverage. Average assets over average equity. Now, this number, if this number is 1, what does it indicate about the leverage of the company? That company has leverage or that company has no leverage? That company has no leverage. Okay, so these are some technicalities behind this decomposition. Okay, we'll discuss more, but let's try to understand that how we can decompose this. Then we'll discuss on the factors. Okay, now what I was saying that it is possible that a company can increase their ROE either by taking care of return on assets or by taking care of the leverage. So a business does a business strategy, applies a business strategy successfully, it is possible to have a greater profit and you will have a higher return on assets. You probably can recall that we have a operating leverage and the financial leverage. Can you recall? Operating leverage, financial leverage. Have you heard about this thing? Operating leverage and the financial leverage. Yeah. So if you can manipulate the operating leverage, remember I'm not using the manipulate here in a negative sense. I'm using the leverage, sorry, I'm using the manipulate in a positive sense. I mean, you are making some strategical changes in your business by changing your fixed portion of your manufacturing cost or by changing your variable cost portion of the your business. In that case, you are playing with your business strategy. In that case, you will be able to have a response of ROA. If it has a positive response, you will get a positive ROE given that leverage remains same. But other than the playing with the business strategy, there is another strategy available to you. There is the financial strategy. So if you play with the financial strategy, in that case, what can you do? You can also improve the ROE. So how it is possible to increase the ROE by playing with a financial strategy? If you can increase the use of leverage, you can increase the use of leverage. Okay. Sometimes you will see that the cost of borrowing in market is very low. For last couple of years, when the pandemic reached momentum, the cost of borrowing went down to a significant extent. So companies took the advantage by increasing their leverage, by capitalizing the opportunity, because they found that their incremental investment will provide greater return, which is over the cost of borrowing they have to incur. In that case, you are increasing the amount of leverage. If you increase the amount of leverage, because your marginal return from investment is greater than the marginal cost of borrowing. In that case, taking leverage is a good way, or taking leverage is recommended. So ROE can be improved in this way. Yeah, changing capital structure, taking debt, these are the strategies we are looking for. Obviously, these are financial strategies. And return on assets can be shown in two variants. I already have highlighted this to you, that how can you make these two variations, and there are reasons that why these variations are why these variations do exist. And now ROA. If we take this variation of ROA, our numerator is net income and our denominator is average asset. This is one of the variations of ROA. There is no wrong, it is also acceptable. Okay. So this ROA can be decomposed and be broken down into two more ratios. How? If we take net income over revenue, revenue is particularly written in case of service company, you will see the service revenue, or in manufacturing company, you'll see the sales revenue. And revenue is a kind of more precise accounting term. So it indicates the sales, or it indicates the amount of gross earnings you are generating by selling or by rendering services of your company. So this reflects the profit margin. This reflects the profit margin. And we have this numerator, we have this denominator. So for getting the return on assets in this abridged form, we need to keep the net income here in this way, but we need to find out a way to vanish the revenue. That is the way that how we can make decomposition. So how can we make a decomposition if we get a turnover ratio of asset turnover? So if we make a asset turnover in this way, that either sales over average asset or revenue over average asset, in that case, that is turnover ratio. So what we are seeing here, we are saying that ROA can be increased by, or ROA can be changed by changing the profit margin, or can be changed by changing the turnover. And you probably can recall that we have talked about leverage in previous slide. We have talked about leverage in previous slide. Now, if we add the leverage in this part, leverage was average assets. Here we write average equity. Now, if average asset and average asset are vanished, we have remaining net income over, we have which are remaining. Yeah, these two things are remaining: net income over average equity. In this way, we can make a three-factor decomposition of ROE. And this is the more complete. And first term on the right-hand side, I mean this one is indicating the profit margin. And second one is indicating the asset turnover. Third one is indicating the leverage. You can recall that by combining these two, we can get return on asset. And by combining return on asset and the leverage, we can get a return on equity. Is it? Let me take you back. Return on equity is equal to return on assets multiplied by leverage. Return on equity, here it is leverage. So it is possible. Now the question is, we know that how this decomposition has been made. And it is also possible that we make further decomposition. There is a way that we make a 5-factor decomposition of the return on equity. And remember, I mentioned some purposes of decomposing return on equity earlier in today's class, and these are the purposes. Now, we like to discuss that how it is possible to have a good ROE or to have a poor ROE, and we need to find out what are the reasons behind changes of ROE. And if we do not have the reason and we are just happy by seeing that ROE is going up or ROE is going down, we are not doing the financial analysis. Rather, we are solving some problems in the exam script, or we are solving some, or we are writing some financial news in the newspaper. Okay. So financial analysis need to look at more detail, need to reach to more depth. Okay. So this kind of analysis, I mean the breaking down ROE or decomposing ROE in 3 parts is known as DuPont Analysis. And I mentioned about this company in previous class that this company does exist now. And this company, we use the product of this company, and many of us have the HP laptop, and HP laptop uses the raw materials of plastic produced by the DuPont. Okay, so that company first introduced the application of decomposition of ROE. And now the question that if ROE gets improved, we have to ask number of questions. What are those questions? Has the ROE increased for getting high profit margin? And if it is for high profit margin, follow-up question, is it for getting more revenue at a higher price, or we have been able to keeping the price same, but we have been able to keep our expenses low? So there are follow-up questions, and there are some other questions we can ask that if we see that the turnover is same and the leverage is same, just for increasing of the profit margin, that's this company has been able to have a good ROE or higher ROE compared to previous year or compared to its peer groups. Okay. Now, similarly, if the company profit margin remains same compared to previous years and compared to its peer groups, and also its financial leverage same, if we see this company has been able to generate higher ROE because of higher turnover. How it is possible? If you use your asset more efficiently, if you use your asset more efficiently for a given amount of asset, you are generating more sales. In that case, your turnover is doing good and your turnover gets improved. In that case, you will have higher ROE. And the net profit margin remains same and turnover remains same, and you have seen that the company has been able to increase the ROE, not for the first two reasons, I mean the profit margin or the turnover, but it has been able to increase the ROE because it is using now more leverage. So using more leverage, how it is possible? By taking more debt and by reducing the equity or by using less amount of equity in their capital structure. And now there is no right or wrong answer. It is not like that if a company increases leverage, the company is not doing good, or if the company is decreasing the equity, the company is not doing good. So there is no right or wrong answer. We have to find out all goods and all bads behind taking a decision. Okay. I have mentioned that when the marginal cost of borrowing is less than the marginal return from investment, in that case, it is always wise to rely on the financial leverage that will improve your ROA, and that will also help you to get a higher ROE. Okay. Now let's try to solve a simple problem here, and we'll then make an exercise to find out where are the numbers in the financial statements. Okay. Okay. So here you see three companies, and three companies information have been provided: the sales, net income, average asset, average equity, average liabilities. So I will ask the responses from you in chat box regarding the answer, that how you will get the ROE. So instead of getting the ROE first, I'm more interested to get the breakdown first, I mean the factors first, then we will compare it with the ROE. Okay. So please solve this by yourself and give me the answer first for the company A. What is the net profit margin? What is the net profit margin for the company A? Write your answer in the chat box. Okay. You are writing in the decimal form. Okay, 0.1. Then for company B, I see responses are coming too fast. Okay, 10%, it is 5%. And for company C, 200 over 6,675. Okay, you are more precise. You are providing precise answer. 3%. Okay, if we make an average of all of this, we get 4.7%. Sorry, 4.7. Okay, next turnover. So what we have learned, the sales over average asset. So if it is 2,000, the average asset is 1,000. It should be 2. Okay, and it should be 2, and it should be Someone has written 100%. Now I'm in the turnover. Uh, 4.45 times. It is for which one? Yeah, for company C. Okay. The average is 2.82. It is usually expressed in terms of X. X indicates the times. Okay. So for $1 of sale, for $1 of asset, how much times of sales is generated? And for leverage, company A leverages asset over equity, average asset over equity. It is the classic case 1, and here it is 2, and here it is 1.5. If I'm not wrong, if I write the average, it is 1.5. Okay. Now complete this calculation for ROE. First of all, we get net income is here 200, and equity is here, average equity. We get it is 20%. And alternatively, what can we do? We can multiply 0.1, 2, and 1. We see the same thing. If we multiply these three things, or these three things, or these three things, we get the answer for this. Okay, it is also 20%. Sorry, in decimal form, it is 0.20. And in decimal form, it is 0.20, and average is also 0.20. Okay, so many responses are coming. You are participating very good, in a very good number. Okay. So let me show you the answers for all of the blanks here. Now, if I do not look at the ROE decomposition, what I would conclude, write your response in the chat box. If I would not, if I didn't look at the ROE decomposition for these three companies and also for the average picture, how would I make comment on the ROE for these three companies? These three companies are performing same performance. Okay, it is expected that you have no more a thing to make comment, right? So you have learned that what is the idea and what is the rationale of making decomposition. It is not a kind of nonsense that we are trying to make the things complicated, because rather we have some good reasons to explore the ROE decomposition. Okay, now we see that out of the three companies, company A is getting the 20% by having more net profit margin, or for having more turnover, or for having more leverage. Which reason is driving the 20% ROE of the company A compared to company B and company C? Which is contributing more? Yeah, good. Net profit margin. I was looking for this answer. Now, how it is possible that a company is outperforming in terms of net profit margin compared to its peer companies, compared to its industry competitors? How it is possible? How it is possible? What is the simple definition of profit from economics? What is the simple definition of profit? Either you can charge higher price. Yeah, revenue minus expenses, right? So they are generating more revenue either by selling more units of product or selling the same unit of product at a higher price, or they have been able to reduce the expenses to a greater extent, which was not possible or which has not been possible for company B and company C. Now, the follow-up question. If the reason you have explored is that the company has been able to generate more sales, the company has been able to generate more sales, that's why this net profit margin is higher. I mean, obviously, the company has been able to generate more sales at a higher profit margin, at a higher price. Do you think this strategy is sustainable? Sustainable in a sense that in a longer run, you will be able to have a higher profit margin compared to your competitors. Yeah, it is not sustainable. You are very straightforward. It is not sustainable. Okay. What is the likely response in the industry if you have a higher profit margin? If you have a higher profit margin, what will be the likely response from the industry? If you just think of the Porter's 5 factors model, so many things will be integrated here. It will invite the competitors. It will attract new competitor, right? Yeah, it will attract the new competitor and you will be forced to reduce your profit margin. So that's why the answer is that the maintaining higher profit margin is not a sustainable thing. So you see how many things we have explored together and how many follow-up questions we have asked from a simple number. Okay, so in this way you have to approach. Now, next thing, company B. Compared to two other companies, I mean the company A and company C, in which factor company B is doing better? I mean, doing better in a sense, I mean, which one is contributing more to have a same ROE for company B? Is it the higher profit margin from the competitor, or is it the turnover, or is it the leverage? Yeah, capital structure, more precise, the leverage. Okay, you see, the company has a turnover. This company, usually we compare with the average of the industry. Okay, this is our benchmark conventionally used. So from average profit margin, the company is not generating, the company is generating above average profit margin. Above average means from the industry. And the company has below average turnover, but the company has higher leverage above average leverage level. Okay. Now, what is the likely questions from you? I'm not giving you the questions now. What is the likely questions from you? If the company is generating more ROE for having higher leverage, will the company ROE is a reliable for long run? Or it is possible that the company equity holders or shareholders will become happy? maintenance of same level ROE for C. Okay, you have, I mistakenly mentioned some questions, but because due to that, it becomes more risky. Okay. So if a company has a higher leverage, if a company increases its leverage, which is likely to be affected? A company increases its risk for what? There's a blank in my statement. Yeah, leverage is obviously good here to get a higher ROE, but the question is, yeah, someone has, yeah, I'm looking for this answer that the company is inviting more risk of bankruptcy. Okay, yeah, based on the leverage, and the beauty of the leverage is that the equity holders get more profit by using the money of the creditors when this is a good time. They have a fixed cost and they have a fixed financial expenses, but they can retain more profit for them because of the financial leverage. That is the beauty of the financial leverage in a sense. But you see that at the same time, the company increases the risk for what? Increases the risk for bankruptcy, more precise. The company increases the risk for bankruptcy. So when the company increases the risk for bankruptcy, it will have a number of consequences. It will have a number of consequences. And you should have some idea that what are the likely consequences of being more riskier for the bankruptcy risk. Okay. Okay, now company C. In terms of profit margin, the company is doing, the company is underperforming. And in terms of leverage, the company has a leverage which is conforming the industry average. But in terms of turnover, the company is, the company has a higher turnover. The company is efficiently using its asset more efficiently in terms of quantitative number. The company's efficiency level is approximately close to 2 times more compared to its peer groups. I mean, compared to its peer companies. What's the simple answer? I mean, is it good? The company has a higher turnover? The company has a higher turnover. The simple answer is it good? Yeah, is it good? But do you know, there's a limitation of the asset turnover? That should we always be happy if we see the company's turnover is very good? Yeah, one has responded no. Would you please write when we should not be happy always? Instead of having higher turnover, what is the likely reason? When we should not be happy? You can also use some real life cases to give your answer. Capital asset selling. Would you please explain? Yeah, I know the capital asset also includes the fixed asset, but I want to know that higher turnover is not good In which cases? Liquidity problem. How higher turnover invites liquidity problem? I see the responses are not coming. Turnover does not measure earning. Turnover, how turnover measures earning? I do not know. It does not measure earnings. It does not measure net income, right? Fixed asset increases profitability, but selling those hamper firm. Okay. Someone is probably getting this ratio wrong. That it's not kind of sales of asset something. This is the asset. This is the sales of our products or services, and this is the assets what we are using for manufacturing our products. It is not kind of we are selling, or it is the kind of we are selling our assets. Okay. It is a kind of for 1 unit of dollar, how much dollar sales we are getting. So if I like to explain, say, for example, for company C, for 1 unit of asset, the company is generating $4.545 of sales. We can sell more with more assets, which we are not doing. Okay, we can sell more with more assets, which we are not doing. And if we increase our sales and we also increase our assets, that will also either keep the turnover ratio in a same level or at a higher level. But you're not probably getting you're not probably getting the way that how turnover, a higher turnover leads to a bad condition. Okay, I'm waiting for 1 or 2 responses. Take time. Reduce the productivity of asset, higher dependence on asset. Okay, 24146. Thank you very much for moving in the right direction. And I was expecting this kind of responses. The thing is that some companies become happy. They make under investment in asset. They make under investment in asset because they see that their sales are in good level and their sales are growing. So they think that they should not go for increasing assets, or what they do, they make under investment of asset because they do not want to increase their capital expenditure. They do not want to spend money for more capital asset. Okay, let me give you an example. Okay, there is an issue that efficiency. Okay, with the more assets, if you increase more, if you generate more sales, obviously you are getting efficient. But there is a cost of higher efficiency. There is a cost of higher efficiency. Say, for example, you are an individual. You have you are an individual, right? You have a capacity that how much work you can do in a particular day, right? So, say your capacity is working for 8 hours. You are an individual. Now, if you work for 12 hours on a particular day, yeah, your turnover, just think of that what I'm trying to say, that your turnover will be bigger number. It from 8, it will become 12. But think of yourself that what will happen to you for spending, for doing more works in a particular day. Say you have not increased your productivity, sorry, you have not increased your capacity. I mean, you have not taken more food, or you have not taken extra rest, or you have not taken any supplement. Rather, you are a single individual. You just have increased your work hours from 8 hours to 12 hours. Yeah, reduced productivity, you will, it is likely that you will have a breakdown. It is likely that you will have a breakdown at a certain point of time. Okay. If you have a breakdown, someone has written a good answer, burnout. You will be burned out. Okay. You see, it happens. It happens in some companies that they do not like to increase their capital asset. So what happens that they make underinvestment. So when they make underinvestment, for some periods or for some years, they can able to generate sales. But over time, what happens for this kind of company, when these assets becomes broken down, their sales dropped all on a sudden. So for some years, for several years, you might have higher turnover, but if you do not make a regular investment in your asset, obviously a regular investment means it is not like that you do not require investment, but you want to make investment. It's not like that. It's obviously demand-based investment. Okay, your company requires investment. You have to invest money for purchasing capital asset. Okay, so to avoid the breakdown, otherwise there will be negative consequences in long run. Okay, so some companies which have it is possible that there is another turnover. Some companies invest less assets because of their strategy, and they have a higher sales. And some companies traditionally have high asset volume relative to their sales. And there is no clear-cut answer that if the turnover is greater, that company is doing good. If the company turnover is lower, the company is not doing good. There is no straightforward answer. Let me give you the industry case. If the companies look like a very service company, okay. Let's think of a company which has a app tech, say 10-minute school is an app tech company. Okay. They do not have a significant amount of assets. Based on their industry nature, they do not have a significant amount of assets. But their sales volume is a big number. monthly 1 crore. Okay, so their sales volume is approximately a big number, 1 crore, but their assets is not a big number. Obviously, we'll consider the annual number, but I just have given you some intuition that what will be their number look like. So you'll see that because of their industry nature, their turnover is likely to be a bigger number or is likely to be a smaller number. Yeah, bigger. Now, if I now ask you, give me a company name from your understanding, which company for its industry nature, for its business nature, should have a lower turnover compared to other industries? Lower turnover. Aircraft companies, automobile companies, pharmaceuticals, then RMG, infrastructure. But I was expecting a industry, but that has not come here still now. Okay. Do you know in terms of making investment, which industry has a higher amount of capital investment in our country? In terms of accumulated investment? Shipping industry. Okay. Textile. Do you think these companies have a very low turnover? I mean, the Square, then the textile, steel, they have a low turnover. Okay. I was expecting the industrial wireless telecommunication company, wireless telecommunication service providing companies. Okay. They have made hefty amount of investment. You cannot compare their investment with other companies. Okay. They are so big, their investment is so big that they take decades to recoup their investment. So you should expect their sales revenue is relatively lower relative to their assets value. So you can expect alternatively their turnover is likely to be a lower number because of the industry nature. Okay, someone has asked that which company we should follow. Okay, the answer is that you cannot conclude your decision to follow a company just by looking at a single financial ratio. Okay, you have to think of a big picture. You have to look at all the financial details, and then you need to make conclusion. Okay, the benchmark is not only the turnover ratio, and the simple. If you like to ask the simple, if you like to give me the simple answer, the answer is that you have to compare with the industry average. You have to compare with the industry average. If it is doing at industry average, in that case, it is doing good. But if it is multiple times greater than the industry average, then some question marks are there. Okay, so let's discuss on some real companies. There is Apple, HP, and the Dell. And by this time, I expect that at least many of you have heard about these companies and you know their business strategies, and you should also recognize that their business strategy, financial strategy should be reflected on this ratio. Okay. So out of the three companies, Apple, HP, and the Dell, which company has a significantly higher ROE? The answer is Dell. Okay. Now you see that in terms of profit margin, Dell is not doing very good. In terms of the asset turnover, the turnover is kind of times approximately over the industry average. And we see their leverage is significantly higher. Significantly higher. Now you see, for having this amount of higher ROE, which is compensating this low profit margin, which is compensating more, the asset turnover or the leverage for getting this significant ROE. Have you got my question? For having low net profit margin, this company Dell, but this company has a significantly higher ROE. Which factor, asset turnover and financial leverage, is compensating more for having this ROE? Yeah. So the answer is leverage, financial leverage. Okay. Now you see that for Apple, why Apple is always preferred? Why Apple is always preferred by investors in a stock market, and Apple is always cited by newspapers for a good investment, for giving more stock return, because investors are very much passionate about investing in Apple, not only for their brand name, but they carry some value in terms of their profit margin. So you see, relative to their they are not, I mean, apple to apple comparison because of their differences in terms of their product offerings. But if you have a close competitor, you need to take these companies. But you see, their profit margin is almost double of the HP, and their profit margin is close to 4 times of the Dell. At least more than 3 times, but not equal to 4 times. But you see, their profit margin is a big number. Okay, now you see, their profit margin is a big number. What are the reasons behind this? What do you think? I see many of you are Apple users here. Why do you expect that their profit margin is a greater number or greater percentage? Do they have a superior business strategy which cannot be reflected or which cannot be taken out by their competitors? Do they charge higher price, or they have been able to lower their cost, or they have been able to offer a significant appealing product features? Brand loyalty, unnecessary higher price. Good responses are coming. You know much about this company. Stable customer base. Higher price, loyal customer. Price is higher than the cost incurred, much bigger, much higher. Okay. One caveat here is that I'm not an Apple user, but what I like to emphasize that they offer something which is uncomparable, and they offer total solutions, and they offer their customer ecosystem. Yeah, I am looking for this word, ecosystem. They provide a whole array of services to their customers. So customers do not need to go to another platform for alternative use or for taking another services. They get all services from Apple. They get all smart services from Apple, and Apple is providing total solutions. And they have a strategy, and they invested huge amount in research and development, and they always come up with some products which is not comparable, and they do not they have taken their brand value to a level that their bargain power is significantly greater. And their customer base, often people try to believe that their customer base is a loyal customer base. Obviously, loyalty does not come at free of cost. Okay, loyalty comes at cost. So there are some people who are switching from Apple to other products, sacrificing their loyalty to Apple, but at the same time, you see their customer base is growing. Some people are ready, some people are prepared to purchase their product, to purchase the Apple product at a, low feature, compare at a higher price, instead of buying the higher featured phone or higher featured smartphone at a low price. Still people look for the Apple products. Okay, so their business strategy is significantly responsible for having higher profit margin, and their asset turnover is low. You see one picture, it's interesting. This one, their asset turnover is a low number relative to HP and Dell. What do you want to draw from here? Why their asset turnover is lower? I have mentioned something which you can assimilate together to give your answer in a simple statement. Okay, let me look at your responses. Yeah, high investment. They invested a large number of assets compared to others. Yeah, that is the appropriate answer. Investment in terms of what? They have made a significant investment in their property, plant, and equipment category, and they have a significant amount of cash balances in their balance sheet. And it is not only the nature of the Apple, it is the going trend of the companies to have a high amount of cash balances. And there are some issues. There are some research papers that why the cash on balance sheet is growing over time. And also, the company has increased their retail presence in different countries. And also there's an issue of having deferred tax asset. So these are some issues. I like to encourage you to download the Apple download the Apple 10K. Apple 10K means Apple's financial statements from the Apple website. And you will see the investor selection tab in the Apple site. And please read the Apple's financial statements and try to get some facts and figures from the Apple. And it will help you a lot to understand the business and also the financials and also the strategic management. Yeah, high R&D, and it is included in the the PPE. Okay. So next thing we like to highlight, that is what I was saying, that it is possible that ROE can be decomposed into 5 factors. In this way, we see the first is net income over earnings before taxes. And this also reflects that how much tax revenue tax authority is taking, how much profit tax revenue tax authority is taking out from me to include the tax consequences. Okay, so it reflects the tax burden. Which one? It reflects the tax burden. And you see, what's the difference between these two? Earnings before taxes and net income. What is the difference between these two? Tax is the difference between these two. So it reflects the tax burden for me. And you see that another factor, I will mention the name later. You see the EBT, I mean the earnings before tax over earnings before interest and taxes. And what is the difference between these two? Interest expense, right? So it is known as interest burden. Interest burden. And then what it is the EBIT margin. Or you can say it is the operating profit margin, EBIT margin. And it is same as turnover. And it is same as leverage. Now, two things we have got, okay. It demands explanation, tax burden and the interest burden. Okay. Now, what does it indicate? It indicates the tax expenses I'm incurring. So if this value is a higher, if this is a higher value, what does it mean? Net income over earnings before tax. It is a higher value. Obviously, it will be a percentage number. But if it is a higher value, what does it indicate? The company can retain more profit with itself, or the company has to sacrifice more profit to the tax authorities. Higher tax. Yeah, it has to sacrifice more. Yeah. Sacrifice more to the tax authorities. Cannot understand. Okay. Let me write it down. Say, out of the 100 taka earnings before tax, you have a net income of 50 taka. Alternatively, out of the 100 taka earnings before tax, you have a net income of 40 taka. In which case, this ratio, I mean the tax burden ratio, is a greater in this case compared to this case. Yeah. So out of these two cases, in which case tax authority is taking more profit, or tax authority is eating more profit of you? Yeah, in this case, tax authority is taking more profit from you. But note that if you divide, if you subtract this number, this one tax burden, 1 minus tax burden, not okay. Tax burden is essential in this way. I mean, it indicates tax burden, but it might be misleading to you. That you see, if I write here net income over earnings before taxes, it is the more appropriate definition of tax burden. 1 minus net income over earnings before tax. Here you see that here our tax burden is 50. Here our tax burden is 60. Sorry, 60% and 50%. Have you got it now? Now, in which case tax burden is greater? Understand tax burden in this way. This reflects the tax burden, but tax burden is more precisely 1 minus net income over earnings before taxes. Okay, or 1 minus the it is you see that if we do this, we get what? We get ultimately we get the tax over earnings before taxes. So in this case, we see tax over a tax burden is greater here. Yeah, tax burden is higher for case B. So similarly for interest burden, you need to understand that when the interest is eating more of your earnings, your earnings before taxes will be a lower number. So what can you do? You can subtract this number. I mean, earnings before taxes over earnings before interest and taxes. You can subtract this number from 1 to actually estimate the interest burden and get what is happening, in which case interest burden is more or interest burdening is less. Okay. So in this way, we make the 5-factor decomposition, and you can you have to use either 3-factor decomposition or 5-factor decomposition. Okay. So there are some ratios, there are some remaining financial ratios. I believe that you are much familiar with these ratios and will not be exploring this. But in next class, when we'll be opening, we'll try to talk something about which ratios are essential for the financial modeling and which will be more interesting. That which ratios are essential for the looking at the future. I mean, you probably can recall I mentioned the 4th step in the financial statement analysis framework, that is the valuation part in the final task. So the input from the financial analysis will be some ratios for the valuation part. So that is all about for today. Let me stop here. So here we are interested to know that how the financial ratios we learned from previous class can be useful for making financial modeling. Financial modeling helps us to primarily for making valuation and for making future analysis. I mean, for the purpose of future, we make valuation. So for that purposes, in the financial modeling, we can use some materials from the financial ratio analysis. So these are some examples of some ratios which can be useful in building the financial model for the purpose of forecasting. So first thing is sales forecast. You probably can recall the horizontal common size financial statement in which we are taking a financial statement of a particular year as a base year and express the changes of financial statement numbers in subsequent years as a percentage of the numbers in the base year. So over time, if the base year sales percentage is 100, if we express the subsequent sales number in terms of the base year number, we would see like this, say 106%, 108%, 110%, or 95%, or 90% in this way in subsequent years. So this number indicates what? This number indicates the sales growth experienced in subsequent years of this base year. This number indicates the historical sales growth. So this is a big thing for financial modeling. So if we do not do this properly, we will have a number of noises in subsequent estimate. Subsequent estimate like COGS, subsequent estimate, sales general administrative expense, then the I would say the other expenses will not be appropriate if we do not make it properly. So there are a number of ways that how sales forecast can be made. That is not part of our discussion, but the thing is very critical. So one purpose of financial ratios analysis is to help you to make the sales forecast. So if you believe that the future will look like the past for the sales, in that case, what can you do? You can look at the previous sales growth the firm experienced in previous 5 years. And you see that this is 6% from the previous year. I mean the base year. This one is 8% growth from the base year, but the annual growth is not 8%. Annual growth is the difference between these two. I mean immediate previous year. So what can you do? You can have an idea that at which rate the company generated its sales, or at which rate the company's sales grew in previous years. So if you take an average, say 5%, this 5% can be a raw material for forecasting sales in the next 5 years. So in this way, financial ratios helps us to make the sales forecast. So this is one of the examples. Now, expenses can be, the ratios related to expenses can be useful in a way, say that in common size income statement, what you do, if you think of the vertical common size income statement, you express all numbers in a particular year in terms of sales. So what do you get in vertical income statement? If the sales is 100, you will see that 60% is for COGS. Then you have 40% gross margin. Then you have 20% for sales general and administrative expense. In this way, you go forward. So in previous 5 years, if you see that it is 60%, 55%, 35%, or 65% in this way, you get an idea that what will be the approximate percentage of COGS relative to sales. So usually this is the way how COGS is estimated. Obviously, the inflation should be taken under consideration. The future changes in economic condition should be taken under consideration. But you see that this kind of ratio is useful in building the financial model. The same thing will for gross profit, same thing is for operating profit. So for example, for operating profit margin, if you see for the previous 5 years, the company was generating operating profit of 20%, 21%, 22% in this way for previous 5 years. So when you are building financial forecast, building financial model for forecasting future financial numbers, if you see that in your forecast, the operating profit margin has become 40%, which is almost double of the average operating profit margin in past 5 years. So it may raise question that why you are expecting that the operating profit margin will be 40%. How you believe that it is significantly different from the past 5 years? What are the good things coming forward? Or what are is there any good things which didn't happen in the previous 5 years? In this way, and similarly for estimating accounts receivable, say for example, as a part of the current asset in the asset out of the assets, you see that this number, days receivable, days payable, and PP turnover, these numbers will help you to determine what will be the approximate accounts receivable, accounts payable, or what will be the new investment in PPE in coming years coming forward. And about the liabilities, the straightforward leverage ratio is total liabilities divided by total capital or total equity in this way. So some companies are planning to reduce their liabilities by vanishing the debt capital from their balance sheet. So if it has been happening for past 5 years, it will give you an indication that company has an intention to reduce the proportion of liabilities relative to the equities. So you get an indication. But if you see that it remains constant, this number, this remain as a constant for last 5 years, it actually happens in case of banks and financial institution. In that case, you get an idea that the leverage ratio is not expected to change in coming years. And the cash flow related ratios, like operating cash flow relative to sales, these numbers will help you that what will be the direction of operating cash flows in response to changes in sales in coming years. So in this ways, ratios can be useful. And if we try to think of some other ratios, how these are useful and how these are connected, you will see that these ratios, what about we mentioned, this will help us for these things. So leverage ratio will help us to, the liabilities ratio help us that what will be the debt in the capital structure of the firm, whether this will go up or go down. And if you make it make a precise estimate of it, you can get the number for interest expense, because this is directly connected to the debt you are taking from the lenders. Okay, and you see the interest expense, forecasting interest expense has a consequence on the forecasting of income and taxes, because this is a kind of financial leverage. You have to incur it without any choice, and it reduces your taxes burden. So forecasting this interest expense properly will help you to forecast the income and taxes properly. Okay, and you see that when you determine the operating cash flow or the simple cash flow, you'll see our free cash flow, which is your I mean the good cash flow, and you see that you need to determine the cash flow by subtracting the tax consequence, interest consequence. So these are connected in that way. And again, you see that when you have a sufficient cash flow, in that case, you have a you get a signal that you have credit worthiness and you have the capability to service your debt, and you are more prepared to take more debt. So in this way, how ratios are helpful in building the model for forecasting the future financials. So this is all about for financial analysis techniques using financial ratio analysis.